Credit investments, mechanisms and benefits. Exploring the essentials of credit investment strategies. Agenda. Introduction to credit investments. Types of credit investments. How credit investments work. Risks and rewards of credit investments. Strategies for investing in credit. Introduction to credit investments. Credit investments overview. Credit investments provide capital in exchange for interest payments, allowing businesses and individuals to access funds. Key financial concepts: understanding principal, interest, maturity, and bond yields is essential for evaluating credit investments effectively. Importance of maturity. Maturity refers to the duration until the principal amount is repaid, influencing investment strategies and risk assessment. Types of credit investments, different forms of credit investments. Credit investments can include bonds, loans, and other financial instruments, each varying in risk and return. Risk return profile. Each type of credit investment presents a unique risk return profile that investors must evaluate carefully. Informed investment decisions. Understanding the types of credit investments aids investors in making informed decisions aligned with their goals. Role of credit in the financial markets, capital allocation. Credit investments play a crucial role in capital allocation, directing funds to businesses that need them for growth. Business growth. Access to credit allows businesses to fund operations and expand, fostering overall economic growth and innovation. Investor opportunities. Credit investments provide numerous opportunities for investors to earn income, contributing to their financial goals. Economic stability. The role of credit in facilitating business funding and investment opportunities contributes significantly to economic stability. Types of credit investments. Corporate bonds. Definition of corporate bonds. Corporate bonds are debt securities that companies issue to raise capital for various purposes. Investor returns. Investors in corporate bonds receive regular interest payments and the return of their principal amounts at maturity. Risk of default. Investing in corporate bonds carries the risk of default, where the company may fail to make interest or principal payments. Government bonds and municipal bonds. Government bonds. Government bonds are securities issued by national governments to finance public spending. They are considered low risk investments. Municipal bonds. Municipal bonds are issued by local governments or municipalities to fund public projects. They also carry low risk for investors. Investment stability. Both types of bonds are popular among conservative investors seeking stable returns with reduced risk. Mortgage backed securities. Definition of MBS. Mortgage-backed securities are financial instruments that derive their value from a pool of mortgages, providing investors with diversified exposure. Investment opportunities. Investors in mortgage-backed securities can benefit from the income generated by mortgage payments, making it a lucrative investment option. Housing market exposure. Investing in mortgage backed securities allows individuals to gain exposure to the dynamics of the housing market without owning property directly. Issuance of credit instruments. Purpose of credit instruments. Credit instruments are crucial for borrowers to raise necessary funds for various purposes, including investments and operations. Underwriting process. Financial institutions play a key role in underwriting credit instruments, assessing risks, and determining terms for borrowers. Terms of credit instruments. Key terms such as interest rates and maturity dates are established during the issuance process, impacting borrowers' repayment plans. Credit ratings and risk assessment. Understanding credit ratings. Credit ratings evaluate the creditworthiness of borrowers, indicating the level of risk associated with lending to them. Role of rating agencies. Rating agencies provide critical assessments that guide investors in making informed decisions about credit investments. Assessing investment risk. Investors use credit ratings to evaluate the risk of different credit investments, helping them to manage their portfolios effectively. Interest rates and returns. Fundamental relationship. Understanding the relationship between interest rates and returns is essential for credit investors to make informed decisions. Impact of fluctuations. Fluctuations in interest rates directly influence the value of credit investments, impacting potential returns for investors. Credit risk and default risk. Understanding credit risk. Credit risk involves the potential that borrowers will not be able to repay their loans, impacting lenders financially. Defining default risk. Default risk is a specific type of credit risk focusing on the failure to meet interest or principal payments. Interest rate risk. Definition of interest rate risk. Interest rate risk refers to the potential loss in value of investments due to fluctuations in interest rates. Impact on long term bonds. Long term bonds are particularly sensitive to interest rates changes as their prices can significantly fluctuate with rising or falling rates. Diversification and reward potential. Risk mitigation. Diversification helps reduce the overall risk in an investment portfolio by spreading exposure across different credit instruments. Maximizing rewards. A diversified portfolio aims to maximize potential rewards by combining various credit instruments, enhancing overall returns. Financial goals. Investors should align their credit investment choices with their financial goals to optimize portfolio performance. Building a credit investment portfolio. Portfolio diversification. A well structured credit investment portfolio should include a variety of credit instruments to balance risk and return. Understanding financial goals. Investors must align their credit investments with their financial goals to achieve desired outcomes effectively. Assessing risk tolerance. Assessing individual risk tolerance is crucial in building a credit investment portfolio to match investor comfort levels. Market conditions awareness. Investors should stay informed about market conditions as they significantly impact credit investment decisions. Active versus passive credit investing. Active credit investing. Active credit investing requires continuous management and analysis to take advantage of market fluctuations and opportunities. Passive credit investing. Passive credit investing emphasizes long term holdings with minimal trading, focusing on market index returns over time. Advantages and challenges. Both active and passive strategies have unique benefits and risks, requiring careful consideration before choosing an approach. Monitoring and managing investments. Importance of monitoring. Ongoing monitoring of investments helps investors identify potential risks early and respond effectively to market changes. Adapting to market conditions. Adapting investment strategies to changing market conditions is essential for maintaining a healthy investment portfolio. Economic factors impacting credit markets. Investors should stay informed about economic factors that affect credit markets to make educated investment decisions. Conclusion. Income generation. Credit investments provide reliable income streams essential for building wealth over time. Diversification benefits. Including credit investments in a portfolio helps spread risk and enhances overall portfolio performance. Informed decision making. Understanding the risks and strategies associated with credit investments empowers investors to make better financial choices. Thank you.